Yes, sir. Where we ended in the previous class, AIFs were of three categories, wherein the first one included entities like a venture capital fund, medium enterprise fund, and infrastructure funds. In addition to this, we also have category 2 AIFs, which include private equity and debt funds. They can leverage but not hedge. And category 3 AIFs can be both leverage as well as hedge. Does anybody recollect what hedge is?
We never discussed what hedge is.
Hedge is the practice by which we are offsetting our risk by usually techniques like short selling, intraday sales, etc. So that is pretty much a risk mitigation mechanism wherein you offset your overall transactions by purchasing and selling multiple quantities of the same security over and over again. So that is what is hedging, and leveraging obviously is borrowing from banks and other financial institutions and investing that money to obtain better quality returns for your investment. So obviously the more you hedge, the more you leverage, obviously the fund is more at risk. And AIFs by default are entities that are going to take more risk because they invest in startups, as we have already said. Now, venture capital entities also include VCF. VCF is a type of AIF which we have discussed before, existed before 2012. Pre-2012, these entities used to be called as venture capital funds and primarily invested in unlisted companies. And one of the major categories of VCFs included angel funds. So you can call these as the intermediate investors between a shark and probably a venture capital fund. That's what it ideally is. And in addition to this, most of these venture capital and AIF funds invest in unlisted entities for the most part, and that is where most of their investments are. If you look at sectors, they also include usually more risky sectors like biotech, medical services, and so on and so forth. So by default, when you talk about a VCF, it's by nature a very, very risky type of investment. Now, in addition to these qualified institutional buyers, there is something called as private equity. Now, private equity is both in terms of funds and also in terms of investors. These are entities that will usually invest in. No. Private equity are entities that usually will be in the form of a trust or usually will be in the form of a fund, and then they will go ahead and invest in the equity of entities which are not even at an initial stage of unlisted entities. They will be very, very small business ideas where private equity investors will invest. So something that is common between VCF and private equity funds is that both private equity as well as venture capital funds, both of them will invest in unlisted companies. Whereas you would notice most of the mutual funds will invest in listed companies. So in some sense you can say private equity invests in private limited companies or unlisted public limited companies. That is where most of their investments are. Unlike mutual funds and unlike other types of funds where they invest in listed entities. There are also three types of private equity. One is a leveraged buyout, which is very similar to a category 2. So an LBO ideally will be a type of private equity.
You study, move, don't disturb me.
Guys who are not on mute, please mute yourself.
I'm so sorry.
Leveraged buyouts are entities where you will take a loan similar to a category 2 AIF, and then you will invest in private companies and unlisted companies by taking a loan from a bank. And these type of transactions typically will be in businesses that will generate high amounts of cash flow. So that is typically your leveraged buyout. The opposite of this is a MBO. There are two basic types of buyouts, which technically you can categorize as a transaction which involves taking a loan or not taking a loan and then buying the equity shares of an unlisted public limited company. Now, a buyout typically is a transaction wherein you are purchasing equity shares. When you're buying equity shares, you're typically buying equity shares in private companies or unlisted public companies. In an LBO, you're taking a loan. In an MBO, you are not taking a loan, and your existing board of directors and management, which is part of the same private company or unlisted company, they themselves will try to invest in this entity and try to increase their shareholding without usually taking a loan. This example of this happened in the case of Dell Computers. Dell used to be a listed company in the United States. And then the management group, which comprises of their managing director, Michael Dell, they ended up raising money from their friends and family members and a couple of other investors. And the public shareholding of this particular company, which was about 35 to 40%, they reduced it to about 5%. They bought 30% shares in their own company by arranging money through their friends and family members and investors because they did not want the company to continue to be listed. They felt the pressure of a lot of compliances, a lot of information being always required to be shared with them. As a result of this, Dell then became a private company, which is still the case in United States. Dell continues to manufacture products in the same segment. They continue to manufacture laptops. They continue to work in the same segment. But typically, a transaction which is an MBO revolves around their current management buying maximum amount of shares back from the public. So it is not a buyback. In a buyback, it leads to a reduction in capital. So let's say your capital was 10 crores. In a buyback, it can fall down to 8 crores or 7 crores as a case. But in a buyout, 10 crore capital will remain 10. But the ownership will change from public investors to private investors. And if the current management does it, it is called as a management buyout. And if anybody apart from the management who are outsiders, if they do it, then it is called as a leverage buyout. And when a fund assists in this buyout, that is called as a LB, which you see in this case of private equity. So in this case, what is happening is a private equity fund is taking a loan from a bank and investing in the shares of a unlisted public company or a private company and increasing its shareholding. That is what an LB. Is this clear? Any doubts in this? Yeah. Okay. The second type of investment is your typical venture capital investment, which is again done by a private equity fund. And then you have growth capital, which is typically noticed. So you would typically notice a pattern for these kind of capital. You'll have an entity. The entity will have some types. The types will be typically 2 types or 3 types. And they will invest money in certain sectors. And they will have a very unique pattern of investment in the secondary market. That is typically the nature of investment. So you have AIFs, which have 3 categories. You have private equity funds, which also has 3 categories. And then we have angel funds, which is also a type of AIF/VC, depending on when it was started. The alternate investment fund, as you already know, the regulations came in the year 2013. So before this, in 2012 and all, they were called as venture capital. An Indian fund typically is the best kind of AIF. It comes under category 1 of AIF. And they typically ask the least amount of questions. Mostly when you invest in companies, you would want to know about the business model, what kind of products they sell, what industry they belong to, what region they belong to. Angel funds don't really bother too much about that. They just want to invest in life. Which brings us to anchor investors. They are also a type of QIP. So if you go back to the QIP chart, so here we have mutual funds, DCX, AIFs, which we have studied. CIS is very similar to a mutual fund, but it is a company or an LLP which doesn't invest in startups, but it invests in good business ideas. BCF typically and AIF typically invest in startups. CIS does not. Pension fund and provident fund also invest, but again, not in startups. They invest in the market overall. As long as their corpus is 25 crores or more, then only you will put them under the category. If you are a foreign investor, you come under foreign venture capital or foreign portfolio investor. But if you are an Indian investor, so typically we are now adding one more category. Investors can be categorized into foreign as well as Indian investors. So when you have Indian investors, they typically come under the category of anchor investors. And anchor investors also will have some category for themselves. Now, AIs, as we already know, are investors in the securities of all different types of companies, and they can be categorized on the basis of how much money they have invested in the company. So, if an anchor investor usually invests in a company, they will typically invest up to 10 crores. So, if you are going to a public issue, if you are a company and you want some guaranteed investment from some investors and you are not sure whether you'll be able to raise money from the public, you will typically approach anchor investors. These are people who will make sure that they safeguard one portion of investment. Remember, underwriter? Underwriter is a person who ensures that minimum subscription is achieved, right? Anchor investors, you can say, play a similar role to an underwriter, but they are very rich investors who will invest a large amount of money in a company, especially in case of a public issue. So, anchor investors for a public issue is different. For a small and medium enterprise issue, it is different. The two types of anchor investors are. If you're doing a public issue and you are trying to raise up to 10 crores, you can raise 10 crores from two anchor investors. So 5 crores each, or 7 crores each, or 9 crores. You can go up to 10 crores from a maximum of two anchor investors. So that makes it a total of 20 crores rupees. This much you can allocate to anchor investors. So when you are going for a public issue could be 100 crores, public issue could be 200 crores, public issue can be 300 crores. But out of that, how much ever you're giving to anchor investors, you can only give it to two anchor investors if you're trying to raise up to 20 crores, up to 10 crore each for one anchor investor is permitted. If you want to raise more money from anchor investors, then you can go up to 25 crores. But in such cases, you have to take money from 15 such investors maximum. So up to 2 AI maximum. If you only want 2 anchor investors, you can raise 10 crore each from them. If you want more than 2 anchor investors, let's say 2 to 15 anchor investors is what your company prefers because you are not confident in your own company's ability to raise money from the public. That is why you go to anchor investors. It is like if you want to start a new business for yourself, who would you typically approach first? Let's say you have a great business idea. Who would you approach first to raise money? Who would that be? Probably imagine if you were a company. Nobody raising any money to it? Okay. You would typically go to your parents, right? Because your parents will support you the most and they will believe in your idea. So similarly, when a company tries to go for a public issue, they will approach anchor investors first and they will give them a fixed allocation. Fixed allocation means if I'm trying to raise 100 crores in equity shares, what is the minimum subscription? Do you recollect that? How much would that be? Anyone guess? That would be 90%, which is equal to 90 crores. Now 90 crores is a huge amount of money. You can't trust only the public to give you money. And public investors are of many types. You have retail investors, you have non-institutional investors, and you have high net worth investors, etc. So you have one more category of investors who you will call as anchor. Just like a ship uses an anchor to stabilize and keep the ship in one place, anchor investors are people that you will approach so that you get at least some amount of money from this publication. So if you approach and you need only 2 anchor investors, that means you're confident that you will be able to raise money from the public. If you only want 2 anchor investors, you can allocate 10 crores to each one of them. If you want more than 2 anchor investors and up to 15 anchor investors, you can raise anywhere between 2 to 25 crores from them. And if you want more than 25 crores from an anchor investor, then you need to at least appoint 5 to 15 anchor investors each for any investment that you need more than 25. So even if you want an investment of more than 25 crores from one anchor investor, you still need to approach and take money from at least 5. That is what is the meaning of this particular investment pattern. So these investors are going to invest a lot of money in the public issue of a company. If you're in the small and medium enterprise sector, the same investment pattern is allowed for up to 2 crores because you're in the small and medium enterprise sector. If you want more than 2 anchor investors, again, you can take 2 to 25 crores from them. But if you want to take 2 to 25 crores from anchor investors, you need to appoint at least 2 to 15 anchor investors in total. And if you want even more money beyond 25 crores from your anchor investors, then you need to appoint 5 such anchor investors on even in the small and medium. And all the anchor investors will invest money through book building process. Book building process is the process by which your company will allow an auction type process through which people will bid on how much money they want to invest in your company. The book building process is the process by which you create an auction and you provide the minimum price only. You don't decide the final price of the shares of your company. So whenever a company wants to do any issue, they want to raise money for their projects, They can do 4 types of issue. We already know. One is a public issue, another is private placement or preferential issue, another is bonus issue, but it's not going to give you any money, so this is ruled out. And then you have rights issue, right? Whenever you go for public issue though, you can either go for fixed price issue or you can go for a book building issue. Fixed price issue is when the company fixes the price. Company decides per share how much the company needs. So let's say company says 4. They consult the different intermediaries in the primary market and they say, we want 4 rupees, 450 rupees per share. That is typically called as a fixed price issue. In a book build issue, the public will decide the price. Company will only say, I need at least 200 rupees I need per share, minimum. This price is called as the floor price. The final price will be decided based on demand and supply. So let's say Infosys is coming up with a new issue. Currently Infosys is going at 1,400, let's say, and they want to raise more money through a public issue. They can say that already my company shares are going at 1,400. I want at least 1,460 rupees per share. That is called as a fixed price issue. But when the company doesn't decide the price, company says, okay, market price is 1,400. I at least want 1,000 rupees per share. If you want to give us more, that is left with you. Company does that, then it is called as a book build issue. And whenever a company does a book building issue, they issue a red herring prospectus. Prospectus also is of many types. You must have heard about them under Companies Act. So we have red herring prospectus or RHP. You have normal prospectus, which is an invitation to the public to subscribe to your securities. Then you have shelf prospectus. And then you have abridged prospectus. Then you have statement in lieu of prospectus, etc. So these are the 5 types of prospectus. And whenever you do book building, what is the unique feature of book building, which we just learned? Who decides the price in a book build issue?
Public.
So book building, whenever you do book building as a company, you have to find which prospectus? Red herring. Now there is a story behind why it is a red herring. Any of you who eat fish would probably know, what do we use as a bait for a fish? To catch fish, what is typically used as a bait? Does anybody know? Or nobody is on fishing here? Whenever you catch a fish, let's imagine there is a fishing rod, and at the end there will be a hook. And let's say there is water going on. A lot of fishes are there in this water. Fish is a cannibalistic animal. Fishes will eat other fish. Human beings cannot eat other human beings, but fish will eat other fish. So at the end of this hook, you will put a type of meat. That will typically be a fish meat. Now you might be wondering, why are we talking about fish? I'll tell you why. Because that is how you got the name of red herring. Red herring is a type of a fish. Herring is a type of a fish, and the red color herring fish is usually used as a bait for catching other fishes. All the fishes like this meat very much, so they will get attracted to this hook faster, and it will also be red in color. So underwater, it will be very visible. So just like other fishes get attracted to this bait, as a company, you need to attract investors. That is your aim, right? So how do I attract investors? If company fixes the price at, let's say, 450, will investors get attracted? Or if you give the power to the public to decide the price, will they be attracted then? What do you guys think?
Power to public.
If you give more power to the public to decide the price of your company shares, it will attract more investors because they will be participating in this process of auctions. Each investor will fix and bid their own price, and whoever wins the maximum amount of shares in this bidding process, some investors would say, I will bid 400 rupees for 10 shares. Some investors will say, I will bid 350 rupees, but I'll buy 100 shares. Some investors will say, I will bid 450 rupees, but I'll buy 1000 shares. You take a weighted average of all of this, and then you will arrive at an average price. That average price, let's say, is 425 rupees. Any investor who has bid more than 425 will therefore get the shares of this particular company in the public issue, and that process by which you do all of this is called the book building. And the prospectus you need is regular prospectus. A regular prospectus will be filed when the company fixes the price. So when it's a fixed price issue, when the company fixes the price, you just file a prospectus. But when investors and public decide the price, then you will file a red herring prospectus. When do you need shelf prospectus? When you need money repeatedly. There are certain sectors and there are certain companies. For example, infrastructure companies need a lot of money again and again and again. So such companies, rather than taking money from the public once, they will take money multiple times. So they will do multiple public issues, but they will file only one prospectus for multiple issues. And usually, what do we keep in shelf in our houses? Do we keep perishable goods or do we keep non-perishable goods in shelf? Non-perishable goods we keep in shelf. Perishable goods, where do we keep?
In the refrigerator.
We keep it in the fridge, right? Same way, when you keep something in shelf, you automatically know that it has more ability to withstand deterioration, will not get spoiled very soon. So this prospectus also has a long validity, long duration, and you can raise money over and over again from the public repeatedly. So usually a shelf prospectus will be valid for at least 1 year. And in this 1 year, let's say you want money 3 times. Once in May, once in December, and once in February again. So you don't have to file 3 different prospectus for raising money 3 different times. You just have to file one prospectus. And these 3 times, you will file a document called as Information Memorandum. IS. So, under prospectus, you have red herring. You have the regular prospectus. You have the shell. Then you have abridged. Then you have statement in lieu of prospectus. What is the special feature of red herring prospectus? It is used when you do book building, when the public decides the price, and whenever there is a auction style process followed, then you file red herring prospectus. When company decides price, you file a regular prospectus. There is no auction here, and there is no public involved. Shelf prospectus, you need multiple instances where you can raise money. So you want to do multiple issues. usually valid for at least 1 year or more. And whenever you want to raise money, you will file a document called as information memo. Then comes abridged prospectus. Abridged, the word means abbreviation. It's a short form. So the short form of all the other prospectus is called as abridged prospectus. Whenever you file any other prospectus, abridged prospectus will always be attached with your share application form. Or whenever you try to raise money, irrespective of what issue you're doing, you always have to attach an abridged prospectus. This contains only the most important details about the issue. So you can say this is the summary of the entire issue. Most important information will be covered. Statement in lieu of prospectus, therefore, will only be filed when you are raising money from existing shares. Can you tell me when will you raise money from existing shareholders? Which type of issue is that? Rights issue. That is a rights issue only. So, whenever you do rights issue, you will file a statement in lieu of prospectus because your existing shareholders already know about your company. They don't need to know about your price. They don't need to know about what business your company does. They already have invested in your company. So you just need a statement. I need this much money. We are going to expand our business. So please give us this much. So here also, you are typically going for a fixed price. And company decides the price. In this kind of a prospectus. And depending on which type of prospectus, you can also connect the issue with the prospectus. If you're doing public issue, which prospectus will go? What are the options available to you? Can you guess? Public issue can be both fixed price or book build. So when it's fixed price, you just file prospectus. If it is book building, you file prospectus. If you want money multiple times, then you file shelf prospectus. And with all this prospectus, you will also attach a bridge prospectus. If you are doing bonus issue, you will not be able to raise money, but still you need to file statement in lieu of prospectus. If you do rights issue, you will be able to raise money, but it is typically a fixed price issue. Then also you will file statement in lieu of prospectus. Now that leaves us with private placement or preferential issue. You don't even need a prospectus here. Why? Can you guess? You are selecting the investor as the company. So when the company is only selecting the investor, don't you think they would have spoken to each other before? Right? They would have had discussions, they would have had meetings, and they would have already discussed the different aspects of the business. So you just need to inform the stock exchange. You don't really need to find a prospectus whenever you do it. This is the connectivity between issue and prospectus. This affects three subjects again. Companies Act, SDC, and our subject. SDC, you need to also worry about forms. Definitions and other things are similar in Companies Act and other things. And since we are a listed company, we need to go a little bit more in depth to understand. And once we issue this prospectus, we can then decide who is going to give us the support and anchoring. Those people are called as anchors. Okay. Another set of individuals who will help us in raising money from the public is HNIs or high net worth individuals. So in India, there is no specific definition as such, but if you invest less than 2 lakhs, they are called as a retail investor. If you invest 2 lakhs to 25 lakhs, then you don't really come under any category. If you invest 25 lakhs to 2 crores, then you are called as an emerging HNI. You are not yet a high net worth individual, but you are emerging. You will reach there very soon. And if you invest more than 2 crores, then you are HNI. So HNI themselves have 4 categories. Okay. HNIs as such are only 2, but let's reclassify that. If you are a retail investor or let's just call you as a Indian individual investor. This Indian individual investor can be a retail investor, can be non-institutional investor, can be emerging HNI, and can be HNI. Retail investor less than 2 lakhs, emerging HNI 25 lakhs to 2 crores, HNI more than 2 crores, NII, therefore you can presume will invest usually between 2 lakhs to 20. And investors generally are either Indian individual investors or Indian institutional investors. And Indian institutional investors are called as QIB. They have some categories. So either you are an institution or you are an individual. And if you really extrapolate all of this data and say who are investors, investors could be Indian or foreign. Indian investors could be institutional investors or individual investors. Foreign investors can also be institutional investors or individual investors. Indian institutional investors are called QIB. Indian individual investors have 4 categories: retail, NII, emerging HNI, and HNI. Foreign institutional investors are also called as foreign portfolio investors, who are also indirectly a type of QIB. The foreign individual investors are foreign direct investors, which you will also study in ECL under FEMA. So this is basically what are the different types of investors in India. If you need to take screenshots of any of these, please do. Let's go through them again. So these are Indian investors. And these are overall investors. And that brings us to capital market instruments, which we have already covered. So we have equity shares. I'll run through them quickly once again so that you remember. So equity shares are of 3 types: ordinary shares, DVR shares, and what is the third type? Do you recollect? What is the third type of equity shares?
Equity shares.
Yes, very good. All equity shares can vote in general meeting. They can subscribe to the shares of the company. They can appoint proxies. They can receive copy of your annual accounts. They can receive notice of meetings. They can inspect your statutory registers, and they can also attend extraordinary general meetings. All equity shareholders have this ability. Right? Different shareholders don't have these rights. Now, in addition to this, DVR shares have additional rights. They have either additional dividend rights or additional in general. Then we come to preference shares. We already know there are 3 categories: participation, preference shares, we have default, and we have what's the third category? cumulative participating and convertible. They all get a fixed rate of dividend usually, and they will get priority of repayment also. They have participating, non-participating, convertible, non-convertible. Debentures have one additional right compared to preference, which is charge, which gives you the ability to sell any specific asset. They also get a fixed rate of interest compared to preferred shareholders. They will get the money back first. Debentures also can be divided on the same categories of convertibility. But here you have additional categories here. You have fully convertible, partly convertible, and non-convertible. Fully convertible meaning all the shares will be converted into equity shares. But conversion happens between 18 to 36. Non-convertible debentures are not converted at all, so you don't have to worry about them. And partly convertible debentures, usually conversion takes place again after 18. And they have to follow a separate set of rules and regulations if you're issuing debenture. If you're issuing an equity share, we know minimum subscription is how much?
90%.
And when we issue a debenture, what is the minimum subscription?
75.
This is not given in SEBI Act. This is not given under any specific act, but this is as per SEBI ICDR regulations. And whenever you issue a non-convertible security, then you have to follow SEBI ILDS regulations. ICDR means issue of capital and disclosure requirements. ILDS means issue and listing of debt securities. So if you issue an equity share, which are of three types, ordinary, DVR or share, or if you issue a convertible preference share, or if you issue a convertible debenture, whether fully or partly convertible, you will follow ICDR regulations. If you issue any other security, you will follow ILDS regulations. And that is where this minimum subscription of 75 and 90. Bonds we have already seen. We have Indian bonds and foreign bonds. Foreign bonds are of two types, FCCB and FCEB. But Indian bonds can be categorized as four. You have government bonds issued by the Government of India or Reserve Bank of India or public sector undertakings. Three entities usually will issue this. All the bonds usually carry a fixed rate of interest, and since they are directly from the government, they are very safe form of investment. Corporate bonds are issued by companies. They are not issued by the government. Here also you get fixed rate of interest, but you need to obtain credit rating because government issues the bond, you will get your money back. But if a company issues the bond, you're not sure that you will get your money back. Right? That's why you have to be extra careful. If a bank issues a bond or a financial institution issues a bond, then it's called as a bank and other financial institution bond. Bank and if you want only tax saving as an investor, then you have to invest in specific tax saving bonds, which is also issued by the government. So tax saving bonds and government bonds are actually one and the same. But some government bonds don't give tax saving. Some government bonds give tax. And all of them have a fixed rate of interest, which is called as coupon. It's a unique way of calling this as interest. So whenever you see the word coupon is nothing but interest. And in addition to this, we have foreign bonds, FCCB and FCEB, which are discussed. Then comes depository receipts. A depository receipt is again of many types, but usually I will call them as only two. Our book kind of wrongly calls it as IDR, but there's nothing called as IDRs. A depository receipt is a receipt which will fetch the right to purchase equity shares after a few years. So you can almost say that this is like a FCCB, but FCCB is issued in India, traded in India. But a depository receipt is issued in India, but it is traded in America. We'll go to New York Stock Exchange and you will say that we are expanding our business to America. Infosys did this once. Yeah, they went to America, they set up their office and they needed money for their expansion. And instead of raising money from Indian investors, you are raising money from foreign investors. That's the only difference. Till now we are talking about Indian investors, now we are talking about foreign investors. If foreign investors come to India, they are called foreign portfolio investors or foreign direct investors. But if they don't even come to India and if you go there, if the Indian company goes abroad to raise money, that is when a depository receipt is created. If it goes to America to raise money, then it's called ADR. If it goes to any other country, then it is called GDR. Same way, if Google goes to London and starts to open up a branch and expand its business, it will need money, right? So it goes to London Stock Exchange. So from Google's perspective, it is a global depository receipt. But from London investors' perspective, it is a London depository receipt, right? So that is all the question of perspective. We will only look at it from the perspective of the company that is trying to raise money. So if any company, Google comes to India and tries to raise money from Indian investors, that is when our book calls it as an Indian depository receipt. Which, by the way, is probably never going to happen because Google is not interested in really raising money from Indian investors. But if something like that happens, that is what is called as an Indian depository receipt. So a foreign company comes to India, it goes to a domestic depository like NSDL and CDSL and tries to raise money from Indian investors. That is an IDR. If an Indian company goes abroad, then it is called as an ADR. Derivatives are of four types. We have already discussed this. What are the four types? Versus futures. What are the other three? No recollections. Forwards, options, and swaps. Derivatives also can be currency derivatives, commodity derivatives, and security derivatives. There are 6 commodity derivatives in India. We discussed this also previously. You have almond, cotton, gold, silver. What else is there? What are the other two? Yeah. You have steel and you have thermal. These are the 6 commodity derivatives. Currency derivatives are usually in freely traded foreign currencies like US dollar, Japanese yen, yuan. You have Great Britain pound, you have euro. Mainly these currencies will be traded at a future date. Which brings us to the end of this chapter, which talks about trusts. Trusts are of 2 types: real estate investment trust, which invests in real estate, and infrastructure investment trust, which invests in the infrastructure sector. They are very similar to mutual funds, and all trusts will have trustees, sponsors, investment managers, and project managers. So these 2 trusts both have this Trustee is the person who manages the trust, and they are going to ensure that you invest at least 80% in infrastructure assets if you're a infrastructure investment fund, and if it's a real estate investment trust, then they have their own rules with respect to the percentages. Sponsor is the person who is the creator of the trust or the author of the trust. So you can say company's promoter is the sponsor and company's board of directors is the trustee. Same way, you have sponsors who have to at least 15% of the net worth of this particular entity by them. So just like promoters have to at least invest a minimum amount in the company, their minimum amount is 15% for an infrastructure investment trust. Investment manager is going to take care of all the investments, where to invest, how much money to invest. The project manager will ensure that the project is executed. Infrastructure projects, we also remember that for debentures, maturity period is slightly higher for infrastructure companies. All companies which issue debentures should redeem it within 10 years. But if you are part of an infrastructure company, then you have 20 years to redeem a debenture. Same way for preference share, or preference share should be redeemed within 20 years. But if you are an infrastructure company, you can redeem it within 30 years. That is the rule for entities. Similarly, that is why these trusts will prefer to invest in longer duration security so that the projects are completed on time. Then you have securitized debt instruments, which are also commonly called as mortgage-backed securities, wherein one company issues a security and then the security will be backed by a mortgage, meaning that the issuing company will be backed by some sort of guaranteed assets. So for example, company issues security from and raises money from investors. Investors give the company 100 crores. They take this money and invest it in assets, and this asset will generate income. This income will be paid back as interest to the investors. So company will take 100 crores and they will buy land. So if company is not able to repay the loan, all the investors will get a portion of this land. But if they are able to repay the loan, whatever rent they are able to generate from this land, that will be given to them as interest, and after the maturity, they will get the money back. That is a securitized instrument for that company. Chapter. Alright. Any questions? Probably the most important chapter in your syllabus with respect to understanding and interpretation in your examination. It's extremely critical. So you've understood who are the investors, what are the different types of prospectus, what are the different types of issues, what are the different types of trusts, what are the different types of QIBs, what are the different types of AIF, what are the different types of equities, different types of markets themselves, and what are the different types of securities. Alright. So go to the chapter once more. In case you guys don't have a class on Saturday by the regular faculty, I will take up the class depending on what message you get on the group. So, in case the regular faculty is taken, we'll probably meet them. Alright? Take care then. See
Thank you, sir. Thank you, sir.
you.